Okay, welcome to the real estate market update with Catalyst Funding. It's the April 2023 edition. As always, we have the Catalyst Funding founder and CEO, Wade Comeaux. Also, we have our director of lending with Catalyst Funding, Jeff Johnson.
Hello, everybody.
And seen a record number of attendees for any Catalyst webinar that I've been a part of. Is that because we have Jason Bible, Mr. Texas Real Estate co-founder, with us today? Jason, glad to have you. I'll let Wade introduce you.
Yep. Yeah, so I've known Jason for quite some time, and he has definitely made a big impact in the Houston and overall Texas market. I think his opinions are very well thought of across the industry, and his organization makes a big impact across the state as well. So we're very excited to have Jason on the call today. He always has some hot takes, some exciting information, and I want to give Jason a few minutes to talk about what he and his organization do. So anybody who is not familiar with them can learn a little bit more about you. So Jason, you have the floor.
I appreciate it. Thanks, guys, for having me on. I love doing these things. They're always a blast. We run a company called Mr. Texas Real Estate, and essentially we help investors become millionaires through real estate. It's pretty simple. We're a buy and hold company. So we buy mostly single family. We do some small apartments. I bought this office building we have now, but principally we're in single family. And we buy and fix them up and rent them. Sometimes we do short-term rentals through Airbnb or VRBO, but for the most part, we're just fixing them up, putting tenants in them, and waiting for them to appreciate, and then cash it out and do it again. So we do that every day here with our investors and our personal portfolios. But that's pretty much what we do in a nutshell.
Well, great, and I know that you've helped a lot of investors that we've worked with in the past and in the current environment, and they're very happy with what you and your team do. So kudos to you guys for helping change people's financial future. That's a very rewarding thing, but it's also important. So great job there. All right, I think we will go ahead and move to the next slide.
Yep, I'll offer a quick disclaimer and then I'll get out of the way and let y'all dive in the presentation. But this presentation is, as always, for general information only, and no information, documents, or anything presented here that we present as a part of this webinar is intended to be for your knowledge, for your benefit, but we don't assume or have any liability or any part for any loss or damage you may incur. So with that being said, at the end of the presentation today, if we have time, we'll do some questions and answers. If anybody puts any questions in the chat here on GoToWebinar, and we'll announce who is the winner of our drawing for one person getting half off their hard money lending processing fee. So with that being said, let me get out of the way so you can listen to these experts on all things real estate investment for April 2023.
Great, and if we go to the next slide, we'll actually skip this one. There we go. I'll briefly cover some of the Catalyst value propositions, and then we'll go into the presentation. For those of you that do not know, we pride ourselves on being a one-stop shop, both short-term and long-term financing. In that short-term space, that's hard money lending or private lending, give people the money to purchase and repair distressed real estate. And we offer a wide variety of permanent financing loans, from conventional to what are called non-qualified mortgages, which means you do not have to provide any income documentation. And it's really, the qualification is built on the property's ability to cash flow itself. We're also a real estate lending company built by real estate investors. Many of our teammates have invested in real estate, and I own another company that is also heavily invested in the single family space as well. We've been involved in thousands of transactions over the years, and we provide a single point of contact that will give you all these different loan options, which a lot of our borrowers really appreciate. That there's a lot of synergy, and it's just one person I got to speak with, whether I'm doing a conventional loan, non-qualified mortgage, I'm doing a small apartment complex, or I'm doing a hard money loan. Any of those are right in there. Then we also really take a lot of pride in 5-star customer service. So you can check us out on any social media platform and see those 5-star averages across the board. That's all I'm going to cover today, and we can dive right into it. So Jason, we know you have the radio shows and you're on social media giving your opinions about the market all the time. So we want to give you a couple of minutes, just high level, big picture. where do you see the Texas real estate market at today?
Well, I'll give kind of a quick picture of where it's at. And my business mostly focuses on affordable homes. So in the space that we're in, we're mostly competing with first-time home buyers, really houses below $350,000. And I'll tell you what we find in that space is it is still hot. It's still really hot. Multiple offers, multiple, and there's not a whole lot of them left. That's the other thing too, is less inventory and a lot of action. So you may see things that say median home price is down or sales are down or lagging. I'm like, that's true for the entire market. But when you get below that $350,000 threshold, it is a wild market. I track on HAR every month when the report comes out. I pull the data and I look at neighborhoods that have a sales price $350 and below and have at least 30 sales in a year. And that market is up 10% year over year. So on HAR, it may say it's down 2%, 3%, but in the market we play in, it's up 10%. So it's just like it was during COVID. We really, truth be told, really hadn't changed much for us. You guys have probably seen the same thing on the retail side. It's like, man, good house goes on the market, it's gone fast.
Yeah, we're definitely seeing the same thing in that $350,000 and below space. The flippers who have gotten into more difficult situations in this market are definitely playing in, those $700 or $1 million categories. That has slowed. And, we would say if you're going to be an investor and there's an area in which to be cautious in the single family space, it would be the higher end flips for sure. But we're definitely seeing a lot of activity and a lot of interest in those $350,000 and below homes. Although I will say, from an investor perspective, what's very excited about that is, like Jason said, the data shows that $350,000 below is very hot on a end buyer perfected home basis. But what we're seeing to make that even more attractive is that the average investor that borrows from us in our portfolio is paying 72.5% of the after repairs value on those deals below 350, whereas before the rate increases, they were paying 90%. So while home prices have not come down, and it's still a great market, you are able to buy at a discount. Investors are able to buy at a discount on the off-market category. It's still pretty damn impressive. And I think the big reason for that is that interest rates are so much higher that you can't get as much cash flow. So investors are being more selective and paying down a little bit so they can still get the cash flow even though rates are higher. So you actually get excellent equity capture that you never would have seen before the rates went up. Are you seeing that same thing, Jason?
Yeah, absolutely. And I've said too, I think investors are asleep. I think a lot of investors stepped out of the market because rates went up. And I said, this is not time. This is not a time to slow down. And because my prediction is, and I went through y'all's slide deck, and I agree with a lot of it, where we know rates are coming down by the end of the year. And we know rates are going to be lower in 25 and in 26. And you can already see how money markets are reacting. You can see it in your CDs. Like, I just went out and bought, for my reserve account, I moved a bunch of money over to Navy Federal Credit Union because they're giving me like 5.25% on a 15-month CD. So parked a bunch of cash over there. I've got to have it anyway, right? It's reserves. You guys got to have reserves. You can't spend all your money, right? So, but if you look at their 24, 36, 48-month CDs, the rates drop to like 2% because everyone knows what's going to happen. So the problem is a lot of investors are sitting on the sidelines that are not in the game are missing out on all these gains. It's like you're just going to refi in a couple years anyway, so who cares, right? That's kind of how I look at it. So
yeah. I was talking to a guy who works for an organization that sees a lot of stuff coming through, and rents are going up is a thing. So even though your ARVs have gone quite a bit higher, your rents are going up, rates are going up, but prices aren't following the ARVs. So hard money lenders, we lend off of those numbers. So when that spread widens, if the ARVs go up, but the prices don't go up with it, that just means that the investors are getting better deals. It's simple. They just haven't gone up yet. Rates are going up. That's fair. But also rents are going up too, and at a pretty decent clip. So it's not like you're losing that much in cash flow. The only thing that's not going up in step with everything else is the price.
Right.
Yeah.
All great points. Appreciate those insights, Jason. Let's dive into the Houston market. We changed the sequence a little bit to really make sure we deep dive each of the cities that the majority of our borrowers and investors are operating in. And Jason, I know you live in Houston and you really have a lot of insight into this area. So do you mind walking us through a few things on this slide that jump out at you?
Yeah, sure. First of all, I really like that you guys are comparing 2019 because a lot of economists have started doing that because the last 2 years, the data doesn't make sense. In fact, when I was flipping through here, you had Austin in here. At one point, Austin had half a month of inventory in there. I mean, straight, absolutely insane. Like, how do you operate in a marketplace that only has 2 weeks of inventory? I mean, it's absolutely bananas. So, and you'll see when you pull that slide up, all the variability in the data. It's just crazy, right?
Yep.
Houston is what I like to tell everybody. It is one of the easiest marketplaces to operate as an investor. It is the largest marketplace in the country. There is nothing bigger than Houston, Texas. Nothing. That's why it's not in Case-Shiller. You can't put Houston, Texas in the Case-Shiller index because it would skew all the data. So it's an amazing marketplace. Like I said, everything below $350,000, just buy it. Like it's not. They can't make a house. When you really get down to it, you really can't build a house for less than $125 a foot before land. So if we're buying below replacement cost, it's a win. So it's still super affordable here. Like you guys said, interest rates have gone up, and so have rents. Taxes are way up. I mean, if you want to get on Facebook and get in some of those investor groups and just listen to the complaining in there, right? Taxes are way up, and so is insurance. But it's an absolutely amazing marketplace. And I mean, it's so funny. Everybody's freaking out. And I'm just looking at months of inventory. We're at 2.7 months of inventory. Like, you know what? That's a hot market. In Texas, we've got about 40 years worth of data that says we start to see price reductions at about 10 months of inventory. So when I hear a lot of people talking about real estate crashes, I'm like, well, where does the inventory come from? Because we don't have any. If there's any story that comes out of this data, and it's people are staying in their homes longer, there's less homes for sale, and we can't build them anymore. And so that's what's causing a lot of the stuff in the marketplace. And if you're waiting for a crash, you're going to die waiting. I mean, that's essentially what's going to happen.
Yep. I echo all those sentiments. I do want to point out a few things. You know, that months of inventory number, if you just look at the year over year data, which is all people see in the HAR report, everybody's like in a panic mode because we went from 1.1 to 2.7, more than double. But the reality is pre-COVID, 3.9 was the months of inventory, right? And that was actually a very attractive number then as well historically because 6 months is balanced. So to your point, really don't have a lot of inventory out there. Another exciting thing, if you are an owner of real estate, if you're a buy and hold investor, from March 2019 to today, up 35 to 36.8%, depending if you're looking at median or average. So even if the market's down slightly at the higher price points on the median, 3%, you're just looking at a very finite amount of time. There's some seasonality in there, but to be up 35% in 4 years is a pretty incredible number. So a lot of excitement if you look at the numbers deeper and don't just look at the year over year, which I think is a huge mistake comparing year over year to the absolute hottest market.
Well, you know, Wade, one of the things I've been telling folks, I said, look, in December of 2019, if you bought 12 houses for $185,000, paid retail for them, just went in, bought 12 houses, $185,000 in December 2019. Today, you would have $1 million in equity. Like 40% is insane. And here's what I keep telling everybody, it's going to happen again. The data is already coming out now that there's a lot of pent-up demand. Homeowners are just sitting on the sidelines. And when those rates drop, we're going to see another 2 or 3 years of 40%. And sitting around waiting to do something, you got to do it now. You got to be moving now because this is going to happen all over again.
Yep.
Yeah, if you look, it's at the very last slide, we'll get to it, but the affordability index is something like you're talking about 40%. Like there's a lot of room for growth in Houston because we are, even with 37% increase on there, 37% increase over the last 3 years, we're still a very affordable city when it comes to prices, relative to income, et cetera. So even though you've had this big jump over the last 3 years or 4 years, it's still very affordable, especially when you look at the size of the city relative to the other options out there.
Size and amenities, right? Because people that make enough money to buy homes, especially on the upper ends of the range, they want those amenities. They want the restaurants, they want the bars, they want the entertainment, they want the museums, et cetera. And Houston has so many of those things. And it's a very rare combination to have home prices that are this low and the amenities that Houston has to offer. Very rare. All right, let's hit that next slide. So how much are you involved in Dallas, Jason? Before we dive into it, do you do any business up in that area?
I don't. I'll tell you what. I really love Fort Worth. I think it's a great little town, especially the areas between Dallas and Fort Worth, Arlington, those spots. But I don't have anything. Most of my portfolio is between here and Corpus Christi, so that's really my two areas. But it's a great market. I mean, it's Texas, man. It ain't great down here. So
No doubt. Yeah, some interesting data that I'll just mention here. You remember Houston was up 30 some odd percent, depending on median and average. Dallas up 50% from March 2019. That's a stellar number. And I've seen a lot of projections from prognosticators that Dallas is going to have the highest overall increase of the major metros here in Texas over the next few years. I've seen quite a few people say that, Austin, we're just so hot. They're going to struggle to get back to some of the numbers they had a year ago just because it was ridiculous. And then that, Houston and San Antonio are often just more of a steady, consistent increase, but that Dallas, a lot of people anticipate continued upward pressure above the other major metros there for Dallas. Jeff, anything to add there?
I was going to ask Jason. So I can't remember who it was on one of these where we're talking about, because I'm looking at the price, the average price in Dallas, and I think that's Dallas proper. But there is a point where it starts, the market will start pricing itself out as a rental market. You can only charge so much in rent relative to the cost of buying the properties or buying the houses. I would think 475 is starting to butt up against that number. But like I said, that's just Dallas. If you go expand out and up, especially, there's a lot more rental properties and opportunities. But is there a number where you're like, hey, this is that you look at, Jason, and say, this is not something, this is where I stop. This is too much for a rental property.
Yeah, I mean, there's a point at which, guys will tell you the old 1% rule. If it's a $500,000 house, needs to rent for $5,000 a month, and some of those, that's kind of a rule of thumb, and that's certainly a play here. But Dallas isn't a rental market anymore. Most parts of Houston proper, inside the Beltway, are not rental markets anymore because the rents don't keep pace with value. So you're going to have to go into another market. And what you'll see is Dallas. It'll be Dallas, Houston, Austin. But really, Dallas and Austin right now are not great rental markets because they still cash flow. Houston will fall right behind them. San Antonio will be that last market where, eventually the appreciation will be higher than rents, and there just won't be a lot of opportunities for buy rental. But that's coming, and I told everybody that it's coming in the next couple of years because we're not going to see $5,000-$6,000 rent on most properties. Right? $2,000, $2,000, $2,500. So,
yeah. And to be clear, like I said, this is Dallas. We have a lot of we lend up there. We do a lot of deals in the area, but not actually in Dallas proper.
Yeah.
Yeah. One other thing I'll mention is just you look at that days on market in Dallas, and while it is up over the previous year, that 2.1 number is definitely the strongest of the major metros. And then the inventory level is still well below where it was in 2019, 33% lower. As far as total active listings in Houston, it's only up down 18%. So, if you look at it overall, there's a lot of very compelling factors that do say that Dallas has an enormous opportunity for appreciation. Although to Jeff's point, it is more difficult to get the cash flow unless you go to those, markets outside of the major metro itself. Jeff, you want to run with San Antonio?
Sure.
Next slide, please.
So unfortunately, Sabre does not keep the archives like the other services do. So we have a little bit of broken data, but it's a lot of the same story. If you look at, say, the average sales price from 2019, 262, March of last year, 374, and then now 367, we'll call it. So year over year, it's down slightly. But again, if you look at a 4-year period, which is not very long, we're talking 40% gains. Same thing with the median, same concept, 227 to 326, down to 315, so 38%. Months of inventory, 3.2, like the 2.1 in Dallas, you got a 2.7 in Houston, so 3.2 is actually a little better, right? Pending sales, they're down 10%, days on market 72. So San Antonio, I see as a real opportunity for somebody who's trying to do buy and holds. It's basically Houston, just a little bit cheaper. And we're seeing a lot of deals out of San Antonio. Everybody talked to says, hey, we want to get properties in San Antonio. I was there a month or two ago. There's just a lot of opportunities there for buy and hold investors, and there's still plenty of chances to get into that market, in my opinion.
Yeah, we also do some deals down in Corpus. We don't cover that on the update, but I know, Jason, you're certainly not the only investor who is active down there. But I would say, from what we see with the data, as far as the major metros, Houston and San Antonio are 1A and 1B. But I have heard a lot of people going into other areas like Beaumont, Corpus, et cetera. Just out of curiosity, why was Corpus your selection, Jason?
I was doing some kind of rocket camp with the Boy Scouts one day, and I get a text from a buddy of mine who said, I got a 9-unit in Corpus Christi for $125K. Do you want it? And I said, where do I wire my money? And so we just bought an apartment down there and then started. I didn't even go down there and look at it. I was like, this is so cheap. We drove down there, looked at it, and then we ended up buying a bunch more property all literally on that street, down the street. We have a bunch of stuff down there now. But, I started looking at the demographics and some, I mean, it wasn't just that soul event, but we also looked at some demographics and some other things. I'm like, this is going to be a great market. And it is up big time down there, depending on what, sub-market you are in Corpus Christi. But we went down there, we're looking for more opportunities. Could we go to we know a bunch of guys in Beaumont, some guys in Port Arthur. And I was like, yeah, but they're just kind of small, And then right as I was buying in Surfside, that's when we started buying in Corpus, and Corpus has been absolutely amazing for us.
Great. Yeah, I think being willing to go a little outside of the major metros opens your returns significantly. And if you can get comfortable with that, there's a lot less competition than you have in Houston, San Antonio, Dallas. So, and we, as an aside, we as a company are comfortable lending in those other, not the 4 major metros, but other top 25 markets in Texas. So if you or any of your friends are interested in doing that on a hard money and permanent financing basis, we cover those areas very well. All right, let's go to the next slide here. Austin. And honestly, I was a little bit surprised. I would have, before we did this is the first time we've done the 2019 comparison. I would have guessed Austin was up more than 47.5%. I would not think that Dallas was ahead of it because there was such a huge run up. But what Dallas did not experience is the year over year negative 13%. So Dallas was behind Austin, prior to this last year, but that's a pretty big drop year over year, and it takes us down to still 50% increase, which is an amazing number in that time frame. But that was one interesting statistic that I saw. The other thing that I did see is the months of inventory. Everybody's kind of freaking out because it went from 0.5 to 2.5, but it's still right in line with the 2019 number. So certainly not an overwhelming amount of inventory there in Austin. It's just not the absolute hottest market that, I almost recall seeing on record whenever you got, to your point, getting down to a couple weeks of inventory. That's just absurd. Anything else on Austin? Do you have any people over there that you talk with anecdotally? Like, what, you have any word on the street?
Yeah, I mean, my brother lives there. He had to buy a house. He bought 2 houses over, between now and COVID. My parents actually live in Georgetown, which is just north of Austin, that retirement community. And it's just, Austin's just banana land. I mean, it just doesn't, it's like California. So whenever you start looking at like market stuff, I'm like, yeah, I can't make any sense out of it. I'm like, I'm just going to stay out of this. It's like you said, it's 2 up and 2 down. It's like LA, but yeah, it's a wild market. I stay away. I love going there, but as far as investing in Austin, I'm just not real well versed in it because it's so different than the rest of the state.
Yeah, I agree with you. I think the people that I hear do well there's some flippers who've done well over time, although if you got caught in this squeeze being down 13%, I'm sure that was very painful. But the people who are in that 4-unit space, sometimes small multifamily. I know some people that do okay over there, but very, very difficult to do single family investment, even in the suburbs. It's just so damn expensive. The numbers really don't work out. So to your point, we don't spend an enormous amount of energy trying to understand that market because we don't have a lot of investors who focus on it. All right, so to come up with another slide, I thought that this was very interesting that Austin is ranked number 2 amongst the highest job markets. So while I think, there had to be a correction from that outrageous growth that took place, there is a lot of data that still says Austin is a desirable area in which to work. And that because of that, I do think they're going to stabilize over time. A correction was due. That does not mean that correction has to continue in perpetuity by any means. And I think it is going to start to normalize a bit over there. So there are a few other articles talking about Austin not continuing this significant downward trend, not another 13% down year over year, probably more stabilization, what we're hearing. Anything to add on this slide, gentlemen?
The thing about Austin is, I mean, all of these companies are now moving into Austin. That's great. That's why the job market is so good. But even before this happened, and even if they left, I mean, having the university there, and it's a great town. So like, you're always going to have a baseline of people that want to live there. It's never going to stop, right? This is 20, 30 years ago before all this boom happened. Like, there was always UT students that wanted to stay in Austin because it was a great town. So like, no matter how great or bad it gets, there's a floor there that I don't think will ever really go underneath. If that makes sense.
Yeah. Let's go to this next slide. We really look closely at this Texas Real Estate Research Center data out of Texas A&M. There's an interesting chart because it's covering median existing single-family home prices, and you have Texas versus the rest of the United States. And there was a point, and right before the great financial crisis, 08 to 2010, when the rest of the country was really outpacing Texas for growth. But then you notice what I really love about this chart is that you never had that huge go up and huge come down that the rest of the country really saw. Texas was always relatively steady. And that's an exciting thing because to weather that storm was not an easy thing to do. But whenever you look at the right-hand side of the chart, you can see there has been a reduction in value overall. Austin and some other hotter markets being a big part of that. But really running in large part in unison with the rest of the country. Although whenever we go to the affordability index, there are some important pockets like Houston that are doing really well as far as affordability is concerned. But Jason, do you take anything else interesting from this chart?
Oh, absolutely. I want everybody to look at 2008. Yeah, I can't find it either. Yeah, like everyone talks about the real estate crash. Look at the red Texas line. I cannot see the real estate crash on there. It's somewhere before 2010. Maybe it's that little dip right there. Everybody freaks out. Worst real estate crash in the history of the world, and I don't see it on that chart for Texas.
Yep.
That's a good point. I mean, if you look at the peak, the blue peak, I guess, in 2006 to the blue trough, which is like 11 or 12, that's a pretty significant difference. We didn't have that at all. You're right. Nothing.
And,
Yeah,
and to Jason,
blue line for the
go ahead, Jason.
that blue line for the U.S. is you can see that run up 2005 to about 2007, and then that's the real estate crash. That's Arizona, Florida, Nevada, and California. That's what that is. And when you look at their statewide or you look at county data, I mean, there were 40% reductions in prices over 2 years. I mean, California took it in on the chin. But I'm like, here? We didn't have a real estate crash here. In fact, this is what I keep telling everybody. Everyone's like, well, Jason, what are you going to do in the next real estate crash? I said, I won't be here. I'll be in Southern California buying everything to get my hands on. There's no real estate crash here. There's really not. And that's the chart that shows it right there.
Powerful. And as a reminder to everybody on the call, I've heard Jason talk about this too. That's a very different circumstance. That was a real estate specific and a home financing crisis, right? So it was logical that in certain parts of the country that were overheated, that there would be a correction from that. We don't have that now. Credit quality is exponentially higher. I don't know where this foreclosure boom is going to come from because people are in a better situation. Delinquency isn't very high. The borrowers are better. There's not alternative products like there were before. No income, no asset. There's not a ton of arms. Like, it is an entirely different situation from a mortgage financing perspective. And because of that, I don't know where the inventory comes from to have this foreclosure crisis. There's just not enough people who are in financial trouble right now on their mortgages. And that's the other point. People just aren't selling right now because they don't want to give up their rates. So there's not going to be an overwhelming amount of market on the market anyway. And as rates do come down and people are more willing to sell their homes, rates are also coming down. You're going to have more compelled buyers. So that will work, I think, in large part in unison to take advantage of that demand that Jason was talking about earlier.
The biggest thing is, in my opinion, takeaway is the credit quality. Like, there's just, back then there was anybody and their brother could get not only a mortgage, but they could get 5 mortgages. It did not matter. Now, the credit quality over the last 10 years has it's been completely different than what led up to the crisis before. Not even close. Next slide. So I'll cover this one real quick. It's, we talk about new construction a lot. So single family construction permits had a 17% increase month over month. All 4 major metros were positive. This is February, and Houston led the way with a 33% increase over last month. So Jason, this is Houston specific, so I wanted to ask your opinion. We've looked at in previous webinars, we lead the country in new construction permits. We were trying to build faster than anybody else. So how do you think that would affect you and as a real estate investor or other real estate investors that were building so quickly, or trying to at least?
Well, if you pull out the price things, these are not $250,000 homes. These are $500,000, $600,000, $700,000, $800,000 homes. My girlfriend and I are looking at houses right now in Siena, and I don't think they have a new home under 500. Like, it's just these really are. These are higher end homes. They're big homes. They're beautiful homes. Builders don't make any money selling little $300,000 houses. They make money selling $500,000, $600,000 houses. So, yeah, I mean, but I'll tell you this: we ain't building enough of them. That's the other thing. It's like what we are building still isn't enough. Gary Keller said this year, if we continue the same pace of construction to meet demand, would take almost 18 years. So we're just not building enough houses, and it's putting a lot of pressure on the houses that we buy. Pricing pressure, in other words, they're just getting more expensive. So yeah, they got to build more. But these are not the cheap little houses that we built in 2004 through about 2007. These are pretty expensive homes.
Right. We'll go to the next slide. So this slide is covering the demand increases as sales and prices jump. So what we're covering here are the seasonally adjusted residential home sales. So, I mean, and you know, Texas and the U.S. outside of that time, whenever things were kind of disconnected from 2008 to 2010, it kind of moves in large part comparably, but what's really interesting is that starting at that year 2000, whenever the total number of sales were in large part the same, you can just see how Texas has really progressed over the rest of the country over time. And we talk a lot about why that is. You know, you have so many compelling advantages to Texas: robust job market, very attractive amenities in the major metros, no state income tax, reasonable home prices, business-friendly environment. Just so many reasons that you're going to see a lot of transactions taking place in the state, which really helps keep things balanced, right? So this chart, along with others, another reason why I'm really excited about Texas in general. Anything to add to this, Jason or Jeff?
No, I'm good.
Oh. Next slide.
This next slide, this is total months of inventory. And you were talking a lot about inventory earlier, Jason. What do you see on this particular slide that jumps out at you?
So we just don't have enough homes. We don't have enough homes for sale. So the real estate market really changed in 2010. And what we found starting in 2010 is that homeowners are just not leaving their homes. They're staying much longer. And one of the reasons they're staying a lot longer is houses are much bigger. So for the most part, we've seen a huge increase in new construction over the last 10 or 15 years in the size of a house. So when folks buy a house, they kind of tend to stay. And this chart we've just seen, and part of it has to do with demographics too. We had the largest generation, the millennials, started buying homes the last couple of years. And it's putting huge pressure on inventory. So that's, and we actually need to see inventory rise because I think it's too tight. We need to get to about 1 million homes in inventory, but we're about 1.5 million, and I think we're still under 900,000. So we need more properties. Having the market pop up a little bit would be nice too.
That chart kind of solidifies what you were saying about the new construction. Yeah, they're building $500,000, $1 million homes. Those are going to sit a little bit longer. They're tougher to sell. There aren't as many buyers for those. But the red chart, which are the homes that are probably a little more affordable, there's like nothing. Like that is pretty close to the bottom right there.
I'd like to point out one thing. If you look, this chart has somewhat flipped, right? You go back to the end of the financial crisis, there were foreclosed homes on the market, and the months of inventory for existing homes was greater than that of new homes, right? Mm-hmm. Now, you see over time that is flipped, and then in the recent past, the months of inventory on new construction, which as Jason spoke about earlier, is normally a lot more expensive. It's in that price point where things are sitting a bit longer, but you really don't have much months of inventory at all. Still a significant historical low on existing homes in the state of Texas. So that's a very powerful chart. Like there's really been no time, even today, when existing homes were on the market shorter time, other than, this really crazy time during COVID. But you go back anything from 2020 to even to 2012, and it's significantly less months of inventory on existing homes. So I think to your point, those are often the less expensive homes, the ones that are being targeted by investors and most buyers because they want to be at a reasonable price point. This exemplifies that it's a really hot market right now. Jeff, you want to run with this one?
Sure. So this is asking rents reach 6% increase year over year. Kind of what I was talking about earlier in the call. I'll read the first little bullet point, and then the top chart is what I think is the most relevant. Asking rents climbed by $9 or 0.5% from February to March. According to the latest reading from the Zillow Rent Index, 17%. The record high pace was reached in February 2022. But to what we were talking about earlier, if you just look at the top number, the gross number, those numbers have gone up quite a bit. So while prices have gone up and values have gone up, starting in around 2021, the rent spiked up quite a bit. I mean, it went from $1,500 to $2,000 in just 2 years. That is a massive increase. That's a 33% increase, basically. So, like we've been talking about, prices are up, values are up, rates are up, but also rents are helping cover that. So, for your buy and hold investors, it's it's comforting to know that your rents are going up at a level that will keep up with the costs and the rates. And then God forbid rates go down, jackpot. You refinance and all of a sudden your cash flow goes from this margin to a much fatter margin.
All right. I don't have anything to add to that. Interested to get your opinion on this chart, Jason. Rental vacancy rates. What jumps out at you here?
Rent's always going up.
Yeah.
This is going to change a little bit here over the next 2 years for multifamily in particular, because we're building more multifamily now than we have since the 70s, like a earth-shattering amount of multifamily construction because of this issue right here. But and you can see it in the 70s, how low it was in the 70s, and then it popped up in the mid 80s there. And I think we're going to see a little bit of that, an increased vacancy coming up here in the next years. But of course, the nation's getting bigger. More people need places to rent. We're not building them. The other challenge is, and you guys have probably seen this with some of your investors, values have gone up so much, and an investor goes, man, I bought this thing 4 years ago for 140. It's now worth 275. Well, I'm going to sell it, take my money, and go do something else. Well, what just happened? They just took that property out of the rental pool. So that's one of the reasons you're seeing vacancy rates really decline, is landlords are looking around going, man, I get a pile of cash for this thing and maybe upgrade, buy something nice or whatever, and it takes that property out of the rental pool.
Yeah. The other thing is just as prices go up, it's tougher for people to own a home. So they got to live somewhere. So that's why another reason why those vacancy rates are going to keep, as prices go up, the vacancy rates are going to plummet. They're going to keep plummeting. They're going to stay pretty low because there just aren't enough affordable houses for the average citizen.
Another thing here, guys, and that may be the greatest correlation in my opinion, is if you look at the times when vacancy rates have been low, it's in times of high inflation and high interest rates, right? Because how does the government counter high inflation? They counter it with higher interest rates. So if you look at this, the last time that vacancy rates were this low was back in the 70s and early 80s, when interest rates and inflation were very high. So a lot of people cannot buy, and they are really forced into a limited amount of rental opportunities. So just not a lot of vacancy in those times. And I don't know that I see that. Jason, I agree with you. Rates are going to come down eventually. I think inflation is going to be higher for a while, and unless things really change around policy, et cetera, I don't see that drastically changing. I even saw that the target rate now is that they're talking about no longer having a 2% target rate. I think they're talking about 2.3 or 2.6. So they've already kind of changed what the expectation of doing a good job economically for inflation is. So I really think these vacancy rates are going to be a real positive to real estate investors. This is across the country. This isn't just focusing on Texas. Going forward in this higher inflation, a little bit higher interest rate than we had a few years back. I don't know if we get back down to a 2 or 3% anytime soon, with inflation still out there as a threat. You guys agree with that?
Yep. Next slide. So Jason, this is kind of what you were talking about earlier. This is a chart of home prices. It's pretty telling just graphically, comparing January 2022 to January 2023. And I mean, you can draw a line right down the middle of Texas, from Texas up. And if you get rid of the Austin anomaly there, everything to the east is green and everything to the west is yellow or red. So it really speaks to what you were talking about earlier, where the markets that have the high run-ups always have the fastest and most severe drop downs. And the more stable markets, I guess in the East Coast that didn't have those crazy run-ups are looking better, more attractive right now.
Yeah, as Jason said earlier, Austin is just like California. That definitely sticks out on this chart. It's the only California or West Coast like thing, kind of on the eastern half of the United States. So it's kind of funny that played out exactly as you said. Anything else jumping out here, Jason, before we move on?
No, prices ain't going down anytime soon.
So this next slide is covering national home prices and the year-over-year drop that we've seen. A lot of these bigger drops are in certain parts of the country, but I would just encourage everybody, while this is down from that peak that we had during COVID, everybody remember in the markets in which we're investing, these are national numbers, right? In the markets in which we're investing, it's such a different story. And it's even more of a different story, as Jason talked about earlier, if you're investing in those properties in that $350,000 below range, where we're actually up 10% year over year. So there's a couple things to keep in mind when you're a real estate investor. Markets matter, price point matters, right? There's a very different story if you're focused in particular categories geographically or based on the average price that you just can't bake in when looking at the national numbers. You look at this chart or you look at national pundits, you might think there's a reason to panic, but if you're living in Texas, investing in one of these markets, or Florida, or other markets that are really hot, Tennessee, it's a totally different story.
Next slide. So inventory, I'm just going to hit a couple of things. If you look at new listings, to the point of what Jason was mentioning earlier, there just aren't enough homes for sale. If you start all the way back in 2012, it's a nice consistent run up. I don't know what happened in April of 20 there, but it's a nice consistent run up. And then it's just really dropping off a cliff here starting in August 2022. It's fallen pretty sharply. So new listings fell 23% year over year in March to the lowest level on record aside from the start of the pandemic. So to the point we've been trying to make, there just aren't enough properties for sale. And it's going to take a while for that to change. I did like McAllen and Austin and Fort Worth are all in there as far as the fell the least. I guess North Port, I'm not sure. Oh, I'm not sure what that is. Maybe North Portland. But anyways, it's kind of more of the same what we were talking about. Listings are way down, 23%.
Yeah. It's hard to have extreme downward pressure on price with very limited inventory. It's just not how economics works. So that's a good sign overall for more stable market prices. Jason, you were talking a little bit. We'll go to the next slide. You were talking a little bit earlier about your interest rate predictions. We have a few here. You can see most of these people are saying in the second half of 2023 getting into the 5%, 5.2, maybe 6%. It kind of gets progressively higher as we go down these different options. Do you have a certain target that you think is reasonable, or a range you see us getting to by the end of the year, maybe into 2024?
I think we're going to see. I think we'll be either right at 6 or just below 6 by the end of the year. April was looking, or March was looking crazy. I mean, we lost to 1%. I mean, it went from like 7 all the way down to like 6 and some change in like 20-something days. So here's what I do know, and this looks real similar to COVID. I'm having a lot of conversations with mortgage folks and real estate agents and people who deal directly with retail home buyers, and what they have all told me, regardless of how long their career has been, they've never had a list of potential clients this long. And my prediction is we hit about 5.5 and all hell is going to break loose. Like, it is just going to be a flood of buyers and sellers in the market all at once. It's going to look just like COVID did, but it's going to be a lot bigger and it's going to be a lot more sustained. The problem is we have half of the inventory. Now, don't get me wrong, more houses are going to come on the market because people will be selling, but it's already a tight market. And then you just throw all this new demand in there and it's going to be crazy. So I'm telling everybody, like, we get below 6, we hit 5.5, it is on.
I've heard so many people say that. It's going to be the incentive for both sides, buyers and sellers, to really be aggressive. No doubt about it. All right, so next slide. We'll just cover this briefly. I'm gonna skim over it, then go to the next one. Today's rates are about 6.89. So to get to Jason's year-end prediction of 6%, it's a 7/8 type drop, which I think is very reasonable and would be very good for the housing market for sure. And then this next slide, going to housing starts. We always like to show this chart because it's really telling. This goes all the way back to 1960. And for single family home starts, you would assume, I think most reasonable people would, that when the population is more than double than it was in 1960, we'd be building double the homes, right? That just seems like a reasonable assumption. But this is why, home prices are predicted to continue to go up, is that just hasn't happened, right? We built fewer homes from 2010 to 2020 than any other decade that I could see here. And even today, or at the beginning of, in the middle of COVID, when we thought we were building a lot of homes, there were countless other times when we were building far more single family homes, right before the great financial crisis, in the 80s, in the 70s, definitely in the early 70s. And then even not too far off in the 60s, when the population was literally half as much. So I think this is an amazing slide when you think about how many homes are being built versus the population. Jason, what are your thoughts on this one?
Not building enough homes.
Yep.
I mean, that's just not building enough. And I can't remember if it's your next slide or the one after this, but you got a really interesting one in here that shows this in a little bit different format. And I said, we're just not building enough.
So next one. Yeah, you want to go to the next one, please? There you
go. Give us your thoughts on this one, Jason.
This is perfect. All right. So obviously the green one is population, right? And then the blue is number of new homes built. So a lot of folks don't know this, but one of the things that was snuck in during the banking crisis was a limit on what local and regional banks, how much they could lend to real estate developers. So a lot of people think like Pulte Homes goes in and does the development work, puts the houses in. Like, that's not how it works. It's usually a local real estate guy like us that clears the land, puts in the streets, puts in the utilities, and then Pulte, Trendmaker, all those other guys get their little sections, they start building stuff. Well, when Barney Frank and the boys got together and they built that regulation.
It's like a bad rock.
Yeah. So one of the things that those guys put in there was a limit on how much these regional banks can expose themselves for real estate development. Well, here's the problem. If no one's doing real estate development, if no one's moving the dirt around, there's no place to build a house. So that's what a lot of this is. And the problem is it's buried in the consumer protection laws. So DC is absolutely full of morons. So, someone's going to stand up and say, hey, guys, we need to roll back some of these banking regulations so we can build more homes. And then somebody on the other side of the aisle is going to say, well, no, you're trying to, take away these consumer protections and, all that stuff. And this guy's going to stand there and go, no, you don't understand. Like, we need to build houses. If we don't move this legislation out of the way, we can't build more houses. And they're like, no, it's good for consumer protection. It's like, it's never going to change. So this is not going to get better anytime soon. And I don't think it has anything to do with how much it costs to build a home and all that stuff. It's just we don't have enough money to set aside for actual development. And no land gets developed, no houses get built. It's that simple.
Yeah. It's a powerful chart for sure. And this only goes back, keep in mind, previous chart we saw went back to 1960. This only goes to 1994. So the population, if this chart went that far back, it'd be a little complicated if it did, but you're talking about significantly, like this population went from 250,000 to 350 plus, right? Whereas if you go back into the 1950s, that population was like 170, I think, 170 million. So, man, just crazy that they were building as many houses back then as they are now. Really, really telling. Let's look at this affordability index. I think this is the next slide, right?
The last one, yep.
So, this is a very powerful chart. We always look at this, but what I love, thank you, Derek and team, marketing team, for bringing us a comparison again back to pre-COVID, right? So March 2019, look at the affordability of the Texas markets, right? And this is an inverse affordability index. Keep that in mind, right? So this Los Angeles is the least affordable if you're looking at this chart. Let's start on the left. So 2019, you had Dallas at 17, Houston, the 19th least affordable place, Austin, the 29th least affordable, San Antonio, 49th, right? So that's what the trend was then. You go to March of 2022, a lot of these numbers have changed. Austin obviously had a huge run up, right? So they're at 21 least affordable. Dallas 24, Houston 28, and then San Antonio 52. And then rates go up, and look at how it changes now, the numbers, right? Austin 23, Dallas 26, Houston 43, San Antonio 62. So what's happened in this rate increase environment is that there's even more pressure to move to a state like Texas, because with the higher interest rates and all these other things, homes are less and less affordable in these other markets. And the other thing about this affordability index, I always like to remind people, is this is just pure principal, interest, taxes, homeowners association dues, etc. This does not bake in if the state has a state income tax. It does not bake in if gas is more expensive, and all these other things make things less affordable. This is purely housing affordability. So really, I think nothing but rainbows and lollipops going forward for people wanting to move to states like Texas because it's so damn affordable. What do you guys have to add to that?
Oh, I think you're 100% right.
Yep. I was surprised to see Austin 29th on the previous chart down there. I couldn't remember a time where Austin was, where Houston was less affordable than Austin, but I guess so. I think the income had a lot to do with it. There was a $14,000 difference in income between the two. Well, now it's even more pronounced. I guess the prices have gone up. It's quite pronounced.
Yeah, look at this chart. Other than Plano, like Austin
Beverly
income
Hills
is really, really high. Yeah.
That's a tight little narrow
Yeah,
spot.
Plano is such a small area, but and there's tons of corporate headquarters there, so it's kind of a unique thing to even have on the chart. But Austin's a really big area, and it crushes. Look at household income; it's way more than Miami, Los Angeles,
Yep.
New York, but
Yeah.
the home prices are far more affordable. So interesting.
Think about, I mean, think about it. We talk about Austin, how it's just a tough market, and if you look at New York, you're making $15,000 more a year, and your real estate is $250,000 cheaper. That's a huge difference. Could be
So I
worse.
think we're at a good point to see if we have any questions. So Derek, if you're available, do we have any questions today for maybe Jason in particular from the crowd?
So no questions today, but that does give us time to announce our winner and then highlight something special going on next week with both Jason and Wade. So first of all, today's winner for half off your next hard money processing fee is Claudia Amador. Claudia Amador is today's winner. Yep. And then also wanted to let everyone know that a lot of people have watched today's webinar. A number of people follow us on social media after this. One of the things that you'll see on social media is that we have our very own founder and CEO, Wade Comeaux, joining Jason Bible next week. If y'all want to talk a little bit about that, we have a panel next week.
Yeah, we're going to talk about mortgages and rates and kind of where the industry's headed, and it's going to be a ton of fun. So we're going to talk about money.
All right. Well, look forward to the opportunity to go over that with your crew. You always put on an outstanding event. So anybody listening today, if you'd like to be a part of that, definitely look out for Jason and his group on social media, or you can reach out to him or us to find out how you can be a part of that panel that we're going to do next week. So remind me, Jason, what's the exact date and time on that?
I want to say it's Thursday. Let me pull it up. I can drop it in the chat.
You got it right here. Thursday, May 4th.
Oh,
It's going to be 6 o'clock on Thursday, May 4th.
Okay.
And if people can attend in person and also watch remotely, is that correct, Jason? Or is that
I
only
believe so. My tech guy's been working on it. So, but definitely, let me see here. I'm looking for. Here it is. I can drop it in the chat real quick. Yeah, they'll be able to watch online and see us in person. Let's see.
Perfect. Well, definitely looking forward to the opportunity. It's always fun whenever we get together. And Jason has popped that in the chat. But if you have any further questions, please reach out. I think Jason, Jeff, and I were all in agreement that it's an excellent time to invest. So if you're looking for someone who can help you do that, Jason and his team are outstanding. If you're looking for support from a lending perspective, we'd love to hear from you. Our contact information is here as well. But the big takeaway is that now is the time. And if you're not involved with all the data we showed today, hopefully you feel more excited than you did before and see a real opportunity out there. So happy hunting, everybody. And Jason, once again, thanks for stopping by.
Yeah, thanks for having me on, guys. This was a blast.
Thanks, Jason.
Have a good one.